Good morning, and thank you for joining Spear's FY22 results presentation. My name is Quintin Rossi, and I am the Chief Executive of Spear REIT Limited, and I have the distinct pleasure of unpacking the FY22 performance with you today. Spear's successful navigation of FY22 is evidenced by certain strategic objectives that we have achieved in an extremely tough trading environment. Since inception, Spear has operated with a distinct focus on proximity to our assets, active asset management, and a hands-on property management approach. This strategy has continued to create moats around our business and our core portfolio. Spear's regional approach cannot be understated when analysing our business and our core portfolio. The reliable municipal and provincial infrastructure, together with what I call the continuous maintenance and enhancement of the macro provincial infrastructure, continues to set the Western Cape apart from the rest of South Africa. Spear's successful navigation of FY22 was not some abstract idea, but had become a lived experience by every single one of our team members. It's this collective focus and effort of the Spear team that's being recognised and celebrated here today. I believe that what we celebrate gets repeated. And to this point, I would like to thank and celebrate our entire Spear team, our board of directors, and all of our stakeholders for the positive imprint that they have made on the FY22 performance. I truly look forward to achieving many more milestones in FY23 and beyond. If you have any questions during the course of the presentation today, please email them through to info@spearprop.co.za and we'll answer them after the presentation. So having a look at what I'm going to be covering today in the presentation over the next hour or so. So moving into our environmental update. Management has through FY22 maintained portfolio health and the stability of cash flow generation through asset management initiatives which have improved income streams across the diversified portfolio. Cash collections have consistently improved, vacancy contraction has been evident, in particular within our office portfolio, strategic disposals were concluded, renewals and tenant retention targets were achieved, and the balance sheet was bolstered to position Spear for growth in the year ahead. A true sense of optimism exists as we move into FY23. As mentioned in the pre-close presentation, FY22 really was a year of two halves. The efforts put in by our asset and property management teams in the first half of the year, and then the notable shift in the trading environment in the second half of the year, created a positive momentum all the way through to the end of FY22. The rolling back of COVID-19 related restrictions aided the recovery of the office market and broadly said the hospitality sector. On a forward-looking basis, the trading environment has shown consistent improvement from that which we have all experienced over the last 12 to 24 months. International travel, tourism, return to office and retail performance reports are delivering all the right data and are pushing us into the recovery path. I believe that FY22 was an inflection point between tenant support measures and income restoration for Spear. As mentioned, office demand has increased since October 2021, resulting in an overall increase in Spear's office accommodation portfolio. The industrial and convenience retail component of our portfolio has continued to display resilience and has contributed meaningfully to FY22. The conversion of 15 on Orange to a fixed income lease had restored earnings from the 15th of August 2021, and also the disposal of the DoubleTree by Hilton prior to year end had eliminated variable income from the Spear portfolio. We've closed out the financial year with a 94% occupancy rate. This fills me with immense pride and energy. Moving into our mission statement and strategic objectives. The greatest source of energy to the Spear team is that we understand the mission, and we have all culturally bought into the mission. And this is to be the leading Western Cape focused REIT, to grow our distributions per share ahead of inflation on an annualized basis, and to operate within the top quartile of our peer group. Spear's hands-on and regional focus have been some of the key drivers to the successful execution of our mission statement. What have we strategically achieved? Firstly, we've achieved a 16.26% growth in our distribution per share for the FY22 year, something that we are incredibly proud of as a team. We've successfully navigated and exited the COVID-19 operating environment. We've maintained income statement consistency with strong rental collections throughout the year, ending off the year with a 98% collection rate. Spear achieved a 94% occupancy rate, in addition to a 94% tenant retention rate on renewals and relets during the year. Our active management approach has mitigated deep negative rental reversions with a positive rental reversion of over 10% for the year. We've seen limited creep in our debtors book as older debts is being serviced together with our current rentals. We've had great success with our asset disposal strategy, as mentioned with the disposal of the Doubletree by Hilton, in addition to the disposal of 6 Telana Close in Belleville South at a 6% premium to our book value after all costs have been deducted. Another milestone achievement for us as a management team is that we have successfully exited variable income exposure within the portfolio ahead of when we initially forecasted. We've implemented a robust PV solar strategy, which has resulted in portfolio accretion as roof lease income has been generated, as well as overhead costs being reduced while still recovering 100% of our consumption. Management had achieved our strategic gearing ratio, also ahead of our forecast, to be in line with our strategy of between 38 and 43%, with a LTV at year end of 39%. Our group ICR has improved to 2.19 times and further improving, bearing in mind that only the last 6 months of FY22 generated hospitality-related income. And then finally, we had raised 254 million of new equity, positioning the business for growth prior to year end. Having a look at our corporate performance. As a specialist REIT on a growth journey relative to our size, Spear has delivered top-notch corporate performance. Spear delivered a total return to shareholders for FY 2022 of 83%. Spear outperformed the All Prop by 61%, the SA REIT Index by 57%, and the JSE Small Cap Index by 44%. The above is calculated on the basis that you acquired 1,000 Spear shares on the 1st of March 2021 at a price of R5.20, with all your dividends having been reinvested on the payment date of each dividend. Also, related to our growth journey, of our 244.8 million shares in issue, 58.5 million shares traded throughout FY22, being a trade ratio of 24% and a rand value of 391 million. The ratio has improved significantly over the years, and this improved liquidity has brought into our register top institutional investors and fund managers specifically during FY22. So moving on to our salient details. Spear owns 31 high-quality Western Cape assets. Our portfolio value at year-end was 4.48 billion rand. Our asset value had declined marginally by 0.41% compared to the prior year. Our average property value was 143 million per property. Our average property value per square meter was 9,669 rand a square meter. Our average in-force escalation was 6.31%. Our portfolio GLA, 457,950 square meters, with a portfolio occupancy of just on 94%. This, I do believe, is as a result of our tenant-centric approach, coupled with our early engagement strategy, which has also aligned with our historical strategy of always being close to our tenants. Our weighted average lease expiry profile is 27 months, Now, we do make concerted efforts to try and push out this WALE as long as possible. But just given the pure fluidity of the last 12 to 24 months, our focus was on tenant preservation and rent preservation. So we would rather take a potential shorter dated lease in this environment than sit with the vacancy, given the fact that vacancies are that much more expensive and have a long enduring cost on the business. I must also add that we have also conducted longer dated leases, especially on our industrial portfolio, as which I'll get to later, which range from 5 to 10 years. Our average portfolio rental is R98.24 per square meter gross, which includes rates and taxes. And our FY22 collections to what we've billed was just under 98% at year end. Bearing in mind that our CFO told me just before the presentation that that's actually increased now to just over 98%, given the fact that older debt has been settled post year end. Another point that I would like to point out for all on this all listening today is that post the payment of our FY22 final distribution, we are still sitting with 33 million in cash reserves, which we continue to redeploy into the portfolio either through major capex projects when they come available or when they come up, or other portfolio improvements, which means that we don't have to access any debt facilities within our portfolio to do major capex projects within our business. Having a look at our financial metrics, Spear's distributable income per share is 78 cents for FY22. Spear's distribution per share is 68.25 cents for the full year post the application of the 88% payout ratio, which is made up of the 85% payout ratio applied at interims and a 90% payout ratio applied at the final period for FY22. The final distribution per share for the 6 months ending 28 Feb 2022 was 35.19 cents per share, which is a 19% increase from the prior period. Our FY22 distribution per share growth was an impressive 16.26%. Spear's SA REIT cost to income ratio for the interim period was 44.30%. This is slightly higher than normal, bearing in mind that no hospitality income was generated during the first half of FY22, with only from the middle of August to the end of Feb did we receive hospitality income, which obviously which had a negative impact on the gross cost to income ratio, together with some limited tenant support measures and other potential bad debt provisions that we had to make that drove up this slightly higher than what we wanted to be. Spear's SA REIT administration cost to income ratio was 6.86%. Now for us, maintaining a low overhead cost structure is very, very important. And we always try and maintain it between 6.5% and 6.7%. Spear's tangible net asset value is R11.30 per share, being a decrease of 1.74% from FY21. Spear's tangible net asset value net of distribution is R10.95 per share. Spear's loan to value at year end was 39%. Spear's fixed debt ratio 67.03%. This is in line with our strategy of maintaining a 65 to 75% debt hedged profile of ranging from between 28 and 36 months. Now we do believe that given the fact that we are in a rising interest rate cycle, we would weigh up where we are in terms of some asset disposals to potentially rather settle debt as opposed to entering into punitive fixes going forward. Spear's average debt expiry profile is 28 months. This is already a 3-month improvement from the pre-close presentation. Our CFO has continued to do an excellent job managing the debt portfolio within the business, amongst many other things. And as a management team, we commend him. Spear's average cost of debt, 7.32%. Spear's average cost of variable debt, 5.92% at year end. Average cost of fixed debt, 8.34%. So having a look at our collections, FY22's collections were robust And as stated many times by us as a management team, we have seen it trended back to a pre-COVID-19 levels over the course of the year. Encouragingly, we have seen older debt being serviced and settled together with current rental obligations. The billings do reflect revenue after all credits and deferments inclusive of recoveries. So December 2021, the budgets were set at a forecasted revenue of 560 million rand. We had billed 554 million and collected 543 million. This is a just on 98% collection rate, but also notably, tenant arrears at year end amounted to 11.56% compared to the pre-close presentation, which was at 21.4%. So we've seen a notable consistent decrease of tenant arrears. Having a look at the sectoral recoveries, we recovered 98% of our industrial rental. We recovered 97% of our commercial rental build. We recovered 96% of our hospitality rental build and 98% of our retail rentals build. So moving on to the financial performance. Spear's like-for-like income growth for FY22 was 11.19%. Spear's like-for-like net property-related income growth was 6.21%. Spear's like-for-like net property operating profit growth was 3.38%. Having a look at our IFRS compliant income statement, group revenue was 574.8 million. Our property operating and management expenses was 195.7 million rand. Our net property income was 379 million rand, with an administrative expense of 37 million rand, generating a net property operating profit of 341.9 million rand. We had some income statement deductions come through of 25.8 million, generating a profit from operations of 316.7 million rand. Spear's net interest costs for the year was 147.2 million, generating a pre-tax profit of 168.8 million rand. Deduction of taxation of 3.9 million generated a post-tax profit for the year of 164.9 million rand. Our measurement within the REIT sector is distribution per share, and based upon that 88% payout ratio, a 68.25 cents per share distribution will be declared for FY22. Spear's interest cover ratio was at 2.19 times, which already, if you look at the prior year, is an improvement from 2.11 times to 2.19 times. This chart on the screen is a great illustration of how revenue generation and restoration took place over the year, and when we saw the material upticks taking place. You will see that the third wave hit South Africa between May and June 2021. You will also see that during the month of August, we started to recover deferred rentals, as well as we had initiated the commencement of the new lease at 15 and Orange with the Capital and Hotel and Apartment Group on a fixed income basis. Skipping back to June 2021, we saw another uptick in revenue as we had accrued the final income and collected the final payments from the prior tenant at 15 and Orange. In the pre-close presentation and early on in this presentation, I mentioned that FY22 really was the year of two halves. And this picture clearly illustrates just how restorative income generation was from August all the way through to the end of Feb 2022. Notably, at the pre-close presentation, I was very optimistic with the letting activity and the letting momentum taking place across the portfolio. And again, one can see that not just in the contraction of our vacancy rate, but also in the improved revenues month on month to year end. Having a look at our reconciliation of our funds from operation, I have touched on the final distribution per share, the payout ratio, the growth of 16.26%, and then the DIPS growth of 6.29%, which is in line with the forecast we provided to the market May 2021 of having a distributable income growth per share of between 6 and 8%. Looking at the summary of our comprehensive income, 164 million rand, with some accounting adjustments coming through of 18.2 million, predominantly made up of an add back for fair value adjustments, asset impairments of 267,000, deferred tax movements of 542,000, straight lining of leases 20 million, and the antecedent dividend post the capital raise of 10.3 million, giving us a SA REIT FFO of 157 million rand. There were some company-specific adjustments for future CSP awards of 9.4 million, together with provisional tax paid on retained earnings for 2022 of 4.4 million. Our total distributable company FFO was 170.9 million. As you would note, during interims, we declared a distributable income per share of 38.89 cents, which was a capital value of about 79.3 million. And then for the final distributable income per share, we declared 39.10 cents per share, which is a capital sum of 91.6 million, generating for full year DIPS of 78 cents per share. During interims, we had 203 million shares in issue net of treasury, and during our final period, we had 234 million shares in issue net of treasury. As you can see in the slide, the reconciliation of the distribution over the interim period and the final period, the difference there is that the interim period payout ratio was 85% and the final period payout ratio was 90%, giving us a blended annualized payout ratio of 88%, with a distribution per share of 68.25 cents, with a cap being a capital value of 149.9 million rand. Post-tax, we have a net retained income of 16.5 million rand. Having a look at Spear's balance sheet, another hallmark of our business is that we have a easy to understand income statement and a straightforward balance sheet. Total assets, 4.5 billion. Total liabilities, 1.85 billion. Non-current liabilities of 1.7 billion. Current liabilities of 76 million. As stated, 234 million shares in issue net of treasury, compared to the prior year of 205 million shares. Spear's gearing ratio at year end, 39%, compared to the prior year of 45.8%. Net asset value per share of 11.30 rand at year end, with a tangible net asset value per share net of distribution of 10.95 rand. Now, just to stay on this balance sheet reflects the execution of management's LTV reduction strategy. The latter was achieved ahead of our forecast, which truly will bolster the balance sheet and will set Spear up for the next phase of our growth journey. Having a look at our TNAV Bridge. Our TNAV per share at February 2021 was 11.50 rand. Profit for the year, excluding fair value adjustments, was 71 cents. Our distribution paid was 54 cents. Fair value adjustments and impairments was 0.01 cents. Private placement was 0.34 cents. Our IFRS 2 expense for the future CSPs was 0.04 cents. Issue of treasury shares for the CSP was a reduction of 0.06 cents, giving us a tangible net asset value per share at the end of Feb 2022 of 11.30 rand. Payment of the final distribution for FY22 reduces that by 35 cents, and which gives us a SA REIT tangible net asset value per share of 10.95 rand. Having a look at our funding maturity slides, Spear's group debt profile is balanced and robust. With group LTV at 39.05, we have seen a marginal increase in our average cost of funding to 7.32%. Our average cost, total net debt at the reporting period was 1.78 billion. 67% of our debt is fixed at an average cost of 8.34%, with a weighted average maturity profile of 31 months, with 33% of our debt being variable at 5.92% with a weighted average maturity profile of 39 months. On a blended basis, a 28-month weighted average maturity profile. We believe that the debt segmentation is well segmented, has robust maturities, and that truly pose little to no refinancing risk to the business. Following on to our group covenants. At the end of the financial period, Spear's strictest covenants were a LTV of 55% and an interest cover ratio of 1.75 times. At year end, compared to the strictest covenants, we were at, as you know, at 39.05% with an interest cover ratio of 2.19 times. Spear's strictest covenants will amend from FY23 going forward, where it would reduce from 55% to 50% LTV covenants and an interest cover ratio of 2 times. Bearing in mind, just a reminder, is that Spear's ICR will continue to improve given the fact that we now will have 1 full year and beyond of hospitality income coming into the income statement. A successful private placement was concluded prior to year end, raising 254 million at R8.40 per share, which saw the issuance of just north of 30.2 million new shares, which increased the shares in issue to 244 million and the market cap settling above 2.1 billion. Spear remains highly liquid with 230 million in cash availability, and with this also increasing. And further down in the presentation, I will show you the work that we did at Nampak as an example was fully funded out of cash reserves. 280 million rands of debt was refinanced during FY22, and 270 million of debt was settled during the year. Taking a forward-looking approach on our SA REIT LTV, at year end, the LTV, as you know, 39.05%. The disposal of Six Talana will see that reduced by 95 basis points. The acquisition of 27 Junction Road will see it increase by 80 basis points. The disposal of Island Business Park, which is now purely awaiting transfer, it's fully unconditional, will reduce the LTV by 28 basis points. The final distribution per share cash payment will increase the LTV by 1.85%. We are looking to make another industrial investment, which should increase the LTV slightly by 34 basis points. We do anticipate, and given the fact that this is a forward-looking 18 months time horizon, the disposal of 15 on Orange through the call option that we have with the Capital Hotel and Apartment Group should see a 370 basis point reduction in LTV, together with another disposal that we are considering at the moment, which should see a further 122 basis point reduction. So all things being equal, and together probably with a host of assumptions, we would say that within the next 18 months, the LTV would drop below our strategic objective of between 38 and 43% to just under 36%, therefore giving us sufficient headroom to grow the business in line with our strategy. So moving on to our portfolio overview. Spear's top 5 assets reflect not only our less is more approach to owning fewer assets but assets of higher value, but also reflect the diversification of the portfolio. Notably, these 5 assets make up 47% of total portfolio value. They make up 177,000 square meters of owned GLA, which is 38.82% of Spear's GLA. One of the other hallmarks of all 5 of these properties is that they all operate with a very high occupancy rate. The only property out of these 5 that does not have a 90+% occupancy rate at this stage is number 2 Long Street, and this is because it's on roughly an 88% occupancy rate, and we are on the cusp of pushing that back over the 90% at the moment. These properties also display incredible value, as well as really located in high quality locations across the Western Cape. Looking at the sectoral split by value, revenue and GLA, from a value perspective, 6% of the portfolio is made up of hospitality, 15% made up of retail, 29% of value made up of industrial, and 49% of value made up of commercial. From a revenue perspective, 5% is generated from our hospitality asset, 15% from our retail assets, 34% from our industrial assets, and 46% from our commercial assets. On a GLA basis, 4% of our GLA is exposed to hospitality, which is fixed income, zero variable income, 11% exposed to retail, 56% of our GLA, which really has been an incredible moat around our business during the last 18 to 24 months, is made up of industrial, and 29% of our GLA, all located in high quality locations that enjoy high tenant demand, is 29% of our GLA. Looking at the segmented asset profile, we have one hospitality asset, as I mentioned, on a fixed income lease, 6 retail assets, 10 industrial assets, and 14 commercial assets. From an occupancy perspective, hospitality is at 97% occupancy, retail is at 98% occupancy, industrial at 97% occupancy, and commercial at year end, which I do believe is at the cusp now of going over 90%, is at 87%. Having a look at a little bit more granular detail on the commercial portfolio, for those that are familiar with Cape Town, we'll see that Spear's commercial assets are truly located in highly desirable commercial nodes of Century City, Cape Town CBD, Tiger Valley, Brooklyn, Parow, Woodstock, and Pardon Island. Have we felt pain in our commercial portfolio? Yes, there have been some pressure points, but I do believe that the fact that the Western Cape has never been a highly speculative market when it comes to office developments, a vacancy overhang hasn't been a bugbear for our business as much as it has been within other regions and other businesses. Where have I felt the biggest pain over the last, call it 18 to 24 months, is in our Woodstock portfolio, where we do run a 48% occupancy rate, but we are placing aggressive marketing campaigns and aggressive asset management initiatives in place to mitigate that and push that up right up to about 70% prior to our interim reporting period for FY23. Other than that, from a valuation perspective, a revenue segmentation perspective, and a GLA perspective, I believe the fact that we have 36% of our GLA and 34% of our GLA and 36% of our value and 34% of our revenue centered around Century City as a well-established, highly desirable commercial node is a great feather in our cap, as well as our singular CBD asset being number 2 Long Street, which is almost 90% let, being the second highest contributor towards revenue as well as GLA. Moving on to our industrial portfolio. The industrial portfolio from a valuation perspective is split 50-50, about 635 million on either side of multi-let manufacturing and logistics. From a revenue perspective, 55% of our revenue is generated from multi-let industrial and manufacturing, and about 45% of our revenue is generated from logistics assets. From a GLA perspective, there's almost a 50-50 split again. 51% of our assets are, from a GLA perspective, are multi-let manufacturing and 49% logistics. And on an occupancy rate perspective, 97% multi-let manufacturing occupancy rate and a 96% occupancy rate for our logistics portfolio. Looking at our retail portfolio, whilst we generally term our total retail portfolio as convenience retail, we have also segmented some of that convenience into what we call destination retail. 80% of the Spear retail portfolio is made up of convenience retail, and about 20% is made up of destination retail. Where are these destination retail locations? They range from Pardon Island to Viking Business Park, and the convenience retail is centered around Sable Square in Century City Precinct. Having a look at, from a revenue component, 81% of our revenue is generated from our convenience retail assets and 19% from our destination retail. From a gross lettable area perspective, 60% of our assets on a GLA basis is convenience retail and 40% is destination retail, with destination retail having 100% occupancy and convenience retail a 96% occupancy rate. Moving on to our letting activity for the period. During the year, we had 158,424 square meters come up for renewal and relet. We had successfully renewed and relet 149,000 square meters of gross lettable area. This is a positive rental reversion of 10.38%. Now, given the fact that we've always been absolutely transparent with our disclosures, if we had to extrapolate out the anomaly, which is the 15 and orange lease, that went effectively from an asset that was generating 0 to generating what it is generating on the slide, which would symbolize a 221% increase in your positive rentals. We extrapolate out hospitality, and of the commercial, retail, and industrial portfolio, we had 142,000 square meters come up for renewal and relet, of which we converted 133,000 square meters of GLA at a negative rental reversion of 5.57%. Now, notably, this is a 94% retention rate across over a third of the total portfolio. Another point to make is that within our third quarter update given to the market, our negative rental reversions were trending towards a negative 5.85%, and at interim period, a negative 5.78%. So although it's still being negative, we believe that having improved to 5.57%, this must be one of the market-leading rental reversionary schedules that you would be seeing in the FY22 reporting season. Having a look at our tenant and vacancy profile. As mentioned previously, at interims, Spear had a 7.21% vacancy rate. We have, through a lot of active asset management and aggressive leasing, reduced that to 6.24%. We've had a notable improvement in our office vacancies, and this has continued as return to work and return to office momentum has started to increase across the Cape Metro. We have a 28,580 square meter vacancy at the moment across the portfolio, of which 2,200 is in retail, 17,200 in commercial, 8,500 in industrial, and 484 in hospitality. As you can see from the slide, over 50% of the vacancy is made up of offices. From a tenant analysis perspective, Spear currently has 404 tenants across the portfolio. They occupy 429,100 square meters. Based on a GLA basis, our tenant segmentation is as follows. 46% of our tenants are large nationals and international tenants, made up in government and major franchises. 43% of our tenants are national tenants, smaller listed tenants, and professional service firms. 4% are owner-managers, entrepreneurs, and small to medium enterprises. And then we have the 6% vacancy rate. Spear's lease expiry by GLA. We have on average 16% of the portfolio that comes up for renewal and relet annually. We believe that this is a robust profile, a profile that is reflective of our early engagement strategy, and also a profile that reflects the limited vacancy risk that exists across the portfolio. We do see an increased industrial renewal profile for the next financial year in FY24, but we've already started conversations with those tenants to ensure that our retention rates remain in the upper 90 percentiles. Having a look at our valuations, notably, across the 4.48 billion of assets that Spear owns, we only saw a negative 2 million rand devaluation for FY22, which is a 0.05% devaluation of assets. We believe that this is as a result of our conservative approach that we take to asset valuations. We have made even more conservative adjustments to our discount rates, our capitalization rates, as well as our exit cap rates, growth rates, and expense rates for the FY22 reporting period compared to the prior year, which you will see on the right-hand side of the slide. When looking at Spear's portfolio on a total portfolio valuation perspective, you'll see the average portfolio valuation of just under 100 per property of just under 143 million rand, which is 9,669 rand per square meter for a fully diversified portfolio. Now, on a segmented basis, our average property value per segment or industrial is 127 million, which is 4,897 rand a square meter. On commercial is 158 million, which is 16,600 a square meter. On retail, it's 110 million, which is 13,500 a square meter. In hospitality, 279 million, which is 16,700 per square meter. I do believe that the portfolio will continue to be maintain this fair value, given the fact that from a rental perspective, we believe that Spear has always maintained either on market or slightly below market asking rentals, which has not only resulted in a high occupancy rate, but also has resulted in Spear's valuations never being aggressively over market. Moving on to our sustainability update. At the onset of Spear's initiation of our renewable energy drive, as a management team, we set out a goal for ourselves that we would, within the first 2 years of this PV solar strategy, like to cover more than 50% of the portfolio in PV solar. So how have we done? Currently, we have 14 properties that have installed solar capacity, with 2 future projects currently underway, which will take that to 16. We currently have 45% of the portfolio covered with PV solar, with another 6% of future additions coming in, which will be the first milestone of our strategy being achieved to get us to 52% coverage of PV solar before the end of the FY23 financial year. We also were mindful of what the penetration rate would be on every installation, which is effectively the on-site generation compared to what you consume from your provider, either Eskom or council. Currently, we are generating a 22% on-site penetration rate, which we self-generate. And then with the installation of the other 2 projects, that'll push up to 25%, with the other 2 projects generating a penetration rate of 27%. The total kilowatt hour peak installed on our solar is currently 5,626 kilowatt peak. That will increase by another 2,200 kilowatt peak, taking us to 7,831 kilowatt peak. We took a 3-pronged approach when we initiated our solar strategy. The first was a roof rental approach, where we generate 25-year cash flows on fixed term leases, roof rentals, effectively unlocking the roof asset for us as a business. Currently, we have 7 roof rentals with 2 future rentals in the pipeline, giving us a total of 9. We also adopted a installment sale model, where we would utilize the savings generated on the PV solar on that section to effectively pay down that system. We currently have 4 of those, with 3 future in the pipeline, which would give us a total of 7. Then the third leg was a owned CapEx model, where we would identify a high traffic shopping centre, Sable Square as an example, where we deployed over 7.6 million rand of CapEx, and that penetration rate has actually exceeded our expectations and ranges through between 29 and 35%. From an income perspective, how have we unlocked this to improve income for the business? Our average roof rental per property is 153,000 rand per annum. On a future perspective, will be 327,000, giving us an average total on an annualized basis of 194,000 rand, which is effectively a 1.7 million rand a year consistent 25-year cash flow for Spear. On an average saving perspective from the finance portfolio, we would see a total annualized saving per property of 428,000 Rand, generating savings of north of 2.9 million Rand per annum. On a valuation perspective, in terms of the value of the kit that's installed on our roofs, of the roof rentals, we have in total, including future projects, 53 million Rands worth of solar kit. In terms of this finance portfolio, about 13.9 million Rand. So in total, we have north of 75 million Rands worth of solar plant installed across our portfolio. Moving on to our sectoral performance. Spear's portfolio has displayed resilience across the balance sheet and income statement, as I've shown you throughout this presentation. Within the sectoral performance, we can show more granular detail on how each sector has performed and what we are seeing on the ground. From a retail perspective, 48,000 square meters of GLA, which makes up about 11% of the portfolio from a GLA perspective. Notably, 41% of our convenience retail GLA is let to national tenants. All our retail assets are classified as convenience retail. This subsector has truly been the most resilient across asset types within the retail sector. Notably, none of Spear's retail assets are reliant on local or international tourists. Our retail portfolio occupancy has been 95.34%. Our collections have been 98% versus revenue billed for the period. We provided credits and deferments to retail tenants to the values of 1.3 million in credits and 485,000 in deferments. The fourth and the fifth COVID wave has had a very little impact on our retail tenants, and in particular the fifth wave was effectively a non-event for our entire portfolio. The letting activity still remains in line with our expectation, with the bulk of our renewals being concluded per our budgets. We've seen no significant tenant failures occurring, and we don't anticipate any to occur. We also consistently are receiving very favorable feedback from our tenants as they are starting to see much more feet coming through the centres, in particular the fact that our shopping centre, both of our shopping centres are open-air shopping centres, making people a lot more comfortable to come and go. And also we don't charge for parking, so people can access and egress fairly freely. What are we seeing on the ground? We see lower levels of income risk as 100% of our tenants are paying and trading. I do just want to disclose that the gyms and some of our food retailers have taken longer to recover, therefore requiring longer term lease restructuring as a result of the various COVID impacts and social distancing requirements. Another encouraging point is that we are seeing our tenants upgrading their spaces, which means that not only are they generating revenue for survival, but they are also generating enough revenue to reinvest into their operational spaces. Having a look at our commercial portfolio, 132,000 square meters of GLA. All of our commercial assets, as I mentioned earlier in the top 5 slide, are located, and also in the segmental slide, are located in highly attractive and established office nodes within Cape Town. Letting activity has notably improved since October 2021. And this is evidenced by the fact that not only have we been letting up office space across the portfolio, but most recently we had let over 90 parking bays in the CBD to one of the South African banks as they start to bring back staff on a Tuesday, Wednesday, Thursday, and every alternate Friday. Office portfolio occupancy has been at 87%. Our collections have been at 97% versus revenue billed. We provided credits of 311,000 and deferments of 142,000 during the year to our office tenants. Our portfolio remains attractively positioned to offer both expansion and contraction space to third-party tenants, and also our very hands-on and active marketing approach allows us to provide bespoke and tailor-made leasing solutions for interested parties. As mentioned, the hybrid work regime is showing a stronger trend to a 3 to 4 day work week. And if anybody that lives in Cape Town has travelled into the city recently, the traffic on the N1 and the R27 and the N2 has notably increased, which for us as property people, we look at how much traffic is on the road. And also when talking to the Cape Town City Improvement District team, they also weigh the amount of cigarette butts that they pick up on the streets to gauge what the kind of foot traffic is within the Cape Town CBD. And I assure you, per the chairman, Mr. Rob Kane, that those tonnages have continuously increased over the last couple of months. What are we observing? We are observing that the return to office momentum is now a reality. As I said before, the work from home is not a one-size-fits-all solution. We do believe that there are aspects of the commercial world that can work from home, but fundamentally, speaking to tenants within the tech space, speaking to tenants within the design space, within the professional services space, the call for the return to office is now louder than ever. Securing tenants, given the fact that there is increased vacancy across the commercial office sector, will be costly, and that would obviously result in tenant installation allowances and incentives having to be a lot more generous. But we have noted a general nodal improvement in terms of office demand, ranging from 100 square meters to 2,000 square meters. Unlike the rest of the country, in particular Gauteng, shadow vacancies in Cape Town have been extremely rare. And recently, as I pointed out, with the uptick in office demand, we are seeing less and less brokers offering space on behalf of other tenants that are looking to reduce their space within their longer term lease commitments. Moving on to our industrial portfolio. The industrial portfolio, as I mentioned earlier, comprises of 259,000 square meters, making up 56% of our total portfolio. Our industrial portfolio has been resilient over the period, with several new lets and relets taking place in a challenging market. Our industrial portfolio occupancy has just been under 97%. We've collected 98% of our rentals. We've provided no credits and no deferments to our industrial tenants during the year. We've seen consistent strong demand for our industrial rental properties. We concluded a long-term lease over 11,000 square meters this year with Mambas Plastics for their new distribution center. We concluded a new 10-year lease with United Container Terminals, part of Grindrod Logistics business, on a new 10-year lease. We concluded the warehouse expansion together with a new 10-year lease with Nampak Liquids over 14,500 square meters. Just those three total just under 60,000 square meters of GLA, making up 22% of Spear's industrial GLA. Further additions post-year end, which I'll touch on, was the acquisition of 27 Junction Road, which 11,500 square meters of GLA, off the back of a new 10-year and 9-month lease with Pepkor Limited. Observations made. As mentioned, the industrial demand for small to large users remains strong. We call this the small to medium businesses rising out of the ashes of COVID-19. We note that Cape Town is running out of developable industrial land in sought-after locations, which means that pricing, northwardly pricing trajectories are forecasted for existing built and available industrial properties. And then vacancy contraction is evident across the spectrum as demand does outstrip supply. The increased level of load shedding does concern us, but what we did as a management team proactively, we engaged with and concluded load shedding curtailment programs on our large manufacturing facilities, therefore mitigating some of the risk that load shedding presents to our manufacturing tenants within the portfolio. Moving on to hospitality. As announced on SENS, Spear disposed of the Doubletree by Hilton. On the feedback we get from the team at the Capital Group is that occupancies have been consistently increasing, that business has started to return to the Cape Town CBD, and also business travel has actually recovered a lot faster than anybody anticipated. Then just having a look at the earnings slide, which I have shown in the past two presentations, but just the significant impact that the 15 on Orange fixed income lease had on FY22, with a contribution of 10.4 million rand towards our income statement, which would contribute over 5 cents on a property level to the distributable income per share, and would contribute over 4 cents to our group distributable income per share. And that was only for 6 months. In terms of FY23, we'll have a full year's worth of income, which will generate just under 20 million rands worth of rental income for the group, which is on a property dips, it'll be 9.33 cents, and on a group dips, it'll be 4.67 cents. Now, this is purely looking at 15 on Orange in isolation and doesn't take into account any other enhancements, any other vacancies that are let across the rest of the portfolio. Some observations. As mentioned, the core markets have shown strong signs of recovery. We recently hosted the Mining Indaba in Cape Town. Hotels were full, restaurants were overflowing, car rental agencies were without vehicles. So positively, the US market, the UK market, the German and the Dutch market are showing a very, very strong return to normal coming to South Africa. The hospitality sector has had to place less reliance on the local market to generate revenue. And then the meetings, incentives, conferencing and exhibitions business has also recovered a lot faster than anticipated. Just last week, Virgin Atlantic had announced that they would recommence their Cape Town-London route as of November, and then following through into 2023, would look at taking it right the way through the year, which is extremely positive as we now have the likes of Emirates, Lufthansa, Turkish Airlines, Qatar Airlines, and now Virgin Atlantic flight schedules coming back to what we saw in a pre-COVID context. And notably also within the Western Cape, if you consider our busiest time of the year over the December months, a tourism spend for the province was roughly 800 million, which over an annualized basis, that 800 million formed part of a total pot of 5.8 billion, which is extremely encouraging for a sector that has been pained by the impacts of COVID. So having a look at our general business updates across the segmented portfolio. Trading conditions have improved across Spear's portfolio. Our ongoing implementation of our PV solar rollout and water augmentation initiatives continue to bear fruit. Our industrial and retail portfolio is showing the most resilience, which makes up jointly 49% of our portfolio revenue, 44% of our portfolio value, and 67% of our total portfolio GLA, which is very, very defensive. Our office leasing momentum has contributed towards vacancy contraction during the second half of the year. And our final hospitality asset is fixed income, triple net and yielding. Our rental collections continue to remain robust in close to 100%, further bolstering our cash reserves. Our debtors management has been on target with good monthly recoveries and receivables taking place. Our LTV reduction roadmap has been achieved ahead of our schedule. Our asset disposal strategy is on track with notable success for the year. And also our portfolio renewals are continuously being done in line with management's forecast. Having a look at our development projects and acquisitions. The growth journey of Spear has been and will be a mix of organic growth together with development, redevelopment and portfolio enhancements together with the acquisitive growth of income producing assets within the Western Cape. During the year, the following noteworthy events and post-year end took place. As mentioned earlier, we concluded the extension of the Nampak liquids facility in Epping. We extended the warehouse by a further 2,000 square meters. We installed a brand new roof together with a mega PV solar plant. Now this redevelopment cost was 34 million rand, and the lease we concluded was a new 10-year lease with Nampak liquids, and the finalization yield on completion was 9.33%. When I spoke about free cash flow earlier, I also alluded to this particular property. It's worth noting that the full extension and works was funded out of cash reserves. We did not have to go to our bankers or our funders to draw down on any debt facilities to complete this work. Having a look at our development growth, we believe as we traverse out of the COVID-19 operating environment that we are moving closer and closer towards the time horizon for us to push the button on this development in Pardon Island. As stated previously, we would be looking for a development partner to execute on this development with us, and we have been inundated with calls from developers and other REITs to partner with us on this development. Marine Place is a 18,000 square meter contiguous urban where we have been awarded the rights to develop a mixed-use precinct of 52,000 square meters, comprising of roughly 13,500 square meters of convenience retail, approximately 2,000 to 3,000 square meters of what we call hybrid offices, and approximately in a change of our decision making with regard to what type we'd like to do, what type of development we'd like to do on this property. Instead of adding another hospitality product, we'll be increasing our residential offering to approximately 1,000 residential units with uninterrupted views from Groote Schuur, Table Mountain, Signal Hill, Lions Head and Robben Island, as well as the ocean. We believe that this would be a product that, given its proximity to the Cape Town CBD, would be a very attractive mixed-use precinct. We also are conscious about the fact that we are spearheading a change in use within the Pardon Island landscape, and as a result we have also provided for certain, call it high-tech industrial units on the back end of the development. We anticipate, as mentioned, a development cost of roughly 1.4 billion rand, and the target yield on completion is a 10% targeted yield. For the avoidance of any doubt, currently all the structures that are on these urban are fully tenanted and let and yielding, so there's zero income drag on any of the assets that are based on these particular urban that we will be developing. We do still have another 4.5 years to entrench our rights in terms of the approved rezoning we received from the City of Cape Town. In terms of a post-year-end acquisition, which adds incredible value to the Spear portfolio, we had acquired number 27 Junction Road, and it's an 11,500 square meter industrial property, which is comprised of both logistics space and manufacturing space. The property has been let to Pepkor on a new 10-year lease, which will commence within the next 10 months post the completion of tenant-specific installation work. Also, for the avoidance of doubt, the property is currently tenanted and yielding. I was asked on Twitter a few days ago what was the acquisition yield, so I'm pleased to disclose that the acquisition yield on this particular property was 9.78% and had transferred into the portfolio on the 9th of May 2022. And typically, these are the type of assets that you will see more and more of featuring in the Spear portfolio, as we have stated previously, and I'll also talk to it in the outlook, where the strategic objectives will be in terms of the acquisitive growth in the portfolio. And they'll be centered around industrial and convenience retail, together with a host of other asset types. Moving on to our outlook. The Western Cape real estate market has proven to be more resilient than most of the other provinces in South Africa. The provincial and metropolitan infrastructure has made it possible for the entire province to be considered an investment opportunity for Spear. The post-pandemic road ahead offers attractive growth opportunities for our business. We will maintain a bias towards industrial warehousing, logistics, and convenience retail assets within the Western Cape. Spear will maintain and strengthen where needed our best-of-breed management team. We believe that immigration to the Western Cape will continue to gain momentum, which will directly and indirectly benefit Spear as mid to high LSM categories of people with strong balance sheets, disposable income, and employment will utilize our retail centers, will rent our office space, and will operate their businesses from our business and industrial parks across the Western Cape. We have seen improved economic activity across the Western Cape, which is evident in the data provided by Wesgro, AXA, and the retail sector, all reinforcing our optimism. Given the geography of the Cape Metro, the scarcity of zoned land and developable land, we will start to see a further expansion upwards towards the West Coast, upwards towards N1 of new residential, retail, and industrial nodes as more and more South Africans choose to make the Western Cape their economic and residential home. The letting activity for FY22 has given us the confidence that we would see further vacancy contraction across the portfolio in FY23 and beyond. The core portfolio remains defensive in nature, underpinned by strong lease covenants and high quality tenants. Given the diversified nature of the portfolio and our regional focus, we are in a good position to keep delivering on our market guidance and our forecasts. We will seek out growth opportunities within the Western Cape to continuously improve the core portfolio through acquiring and developing real estate assets. We'll continue our strategy of prudently recycling capital into longer dated investment opportunities, as was displayed with the disposal of 6 Telana and the acquisition of 27 Junction Road within the Western Cape. As a management team and as a board, we will remain materially invested in Spear, which displays strong shareholder alignment. We will make continuous operational enhancements to improve the day-to-day operational execution and success of our business. Management's aim is to, within a period of 6 to 7 years, grow the portfolio assets to assets under ownership of roughly 15 billion rand. Now, the following slide is a representation of this, what we call the execution of our inorganic pipeline. Now, what you will see here is that we're showing you the growth from FY18, which really was the kind of commencement of Spear's growth journey in terms of asset growth, all the way through to the FY22 year. And then we have provided what we would call a forecast as to where we see the growth opportunities within the portfolio happening from FY23 to FY28. We anticipate that through some smart negotiation, the utilization of our script, the utilization of recycling capital, and utilization of our debt portfolio, that we can grow this portfolio by a further 9 billion rand by FY28, FY29, with a distinct focus, as I've said numerous times, on industrial, which within industrial will have a subsector of warehousing, logistics, and manufacturing. Given the fact that the world supply chain requirements have changed notably in the last 24 months, we are seeing that a lot of companies are taking a China plus one approach, where they are looking to manufacture more products locally. So we want to be able to play in the space with the large retailers looking to onshore manufacturing, to on-store storage, as we've seen that the historical just-in-time inventory systems are not applicable in this new world that we live in. We'll also see the addition of urban logistics to our portfolio. We'll see the potential addition of data centers, telcos, towers, in addition to convenience retail and mixed use. The largest mixed use scheme, which I just touched on a few moments ago, is the Marine Place, which is the 52,000 square meter mixed use development. But just also for the avoidance of doubt, we're not obsessed with size, but we are rather obsessed with income. So we will grow meaningfully to optimize the portfolio strategy when and where possible. But our focus, and this is an undertaking we give to you as our shareholders, is that growing our income in line with our mission statement is a key and main priority for us as a business. Moving on to our guidance. Spear will maintain its Western Cape focus and consistently seek growth opportunities. We'll continue to acquire high-quality assets in conjunction with the development of brown and greenfield opportunities within our sectoral focus and growth strategy. Our proximity to our assets will remain excellent to enhance asset and property management. To the best of our ability, the FY23 DIPS forecast has been formulated. Our guidance for FY23 will be an increase of DIPS of between 5 and 7% from 2022. Spear's payout ratio will be set at 90% of DIPS going forward. Now, this guidance is provided upon the following assumptions. Our national state of disaster is not unnecessarily prolonged or implemented going forward with relation to lockdowns. There'll be no further COVID-19 lockdowns that limit the economic activity to take place. The vacancies are reduced in line with our forecast, that our lease renewals are concluded in line with our forecast, and that no major tenant failures take place during the year, and that our tenants are able to successfully absorb the rising costs associated with utility charges and municipal rates, and that load shedding does not become a permanent feature in the operating environment. Any changes to this assumption may affect our forecast, and just note that this forecast has not been reviewed by our auditors. As a management team, we will continue to engage with the market. We have adopted a quarterly update initiative, as the team will remain accessible to the market as Spear trades through FY22. And just in closing, Spear will remain obsessively focused on our assets, our tenants, and our overall business operations throughout FY23 in our pursuit of real estate excellence. This brings us to the end of our presentation. I wish to thank you for logging on today and listening to what we had to say, and really just celebrating with us the milestones we achieved in FY22 amidst the tough trading environment. I'll be back on with you in a few minutes with our CFO, Christian Barnard, to field any questions that may have come through during the presentation. Thank you very much. Welcome back. Welcome back to the FY22 results Q&A. I'm joined here by my colleague, Christian Barnard, our Chief Financial Officer. We haven't received many questions, so either the market is tired of hearing me speak or the presentation was comprehensive enough. But just a reminder, we do remain accessible to our shareholders, so if there are any questions that come through that we don't answer during this Q&A session, or if you are wanting to send through something at a later stage, please feel free. We have had 2 questions come through in the past couple of minutes, so I'll just hand over to Kim, our CIO, to just ask the questions for us.
Thanks, Quintin. The 2 questions are from Adrian Jardine. The first one, can you comment on leasing activity that has taken place post-financial year end, especially for the office portfolio? What is the current momentum like?
Yeah, so encouragingly, we are still in that momentum phase. Post-year end, we have, of that 17,000 square meters of office vacancy, we have let approximately a further 1,200 square meters in the northern suburbs, in the Tiger Valley, one of the buildings in Tiger Valley, as well as in Waterhouse in Century City, and on the 18th floor of this particular building, number 2 Long Street. So I'm continuously encouraged. Just even talking to one of our tenants yesterday, they currently occupy about 1,200 square meters with us, and they have actually just acquired another business and are looking at increasing their footprint from 1,200 square meters to 2,000 square meters. And the discussion was, how have you found your staff wanting to come back to the office? And he said that he's had staff that have not been able to function from home because their living conditions may be different. Access to broadband as well as load shedding has played a massive role in people not being able to fully function and give sufficient output working from home. So we continuously see inquiries coming through, and we are trying to, as aggressively as possible and within the confines of economics, offer a win-win rental solution to our office users that inquire within our portfolio. But we are very much open for business, and given the fact that we are so regionally focused, it does help us in the pursuit of reducing that office vacancy even further.
Thank you. The second question from Adrian for Christian. Is it correct that you currently do not use swaps to hedge your interest rate risk? In order to hit your target 75% hedge ratio in the next financial year, would you consider entering swaps, or are you aiming to use disposal proceeds to settle variable rate debt?
Thanks, Kim. We do use swaps. We prefer using a property-specific vanilla fixes, but we have 2 swaps over 2 specific properties which we have entered into in the last couple of months of the financial year, which was very fruitful for us. And we always consider them, but we've generally found that property-specific fixes have been more beneficial to Spear with lower cost to the company. And yes, we would definitely consider entering into swaps if they are at the right pricing point. And we are definitely looking at using disposal proceeds to settle debt, and we will be doing so from the latest disposal that we have concluded in terms of one of the smaller assets we've disposed of being Island Business Park. And if the others are sold that we have in our tail, we will definitely first look at disposing of debt if there isn't any other accretive acquisitions we can do with that specific debt.
Thank you. There are no further questions.
Well, ladies and gentlemen, thank you again for logging on and being with us today. We appreciate it, and we assure you that as a business, our focus is to unlock shareholder value, to create consistent income, and to build a high-quality portfolio within the Western Cape that we can all be proud of. Thank you very much. Take care, stay warm, and God bless.
Thank you.